All right, in this video I'm going to take a kind of a bigger picture look at some of the markets and show you what's happening here. So a lot of things topped in late July. Stock market topped, the banking sector topped, and this is the most important to the Fed. They don't want any more, especially regional banks or any of the major banks, going under. And then let me put the regional banks on here. All right, this is the one that's in jeopardy. If this index was to come down and break these lows, you're going to have more regional banks going under, and the Fed has been pulling out all the stops to prevent that from happening, trying to prop up the banking stocks, and that liquidity, it has managed to keep the banks from making a lower low, but the liquidity is not really wanting to stick in these overvalued sectors. Let me go over to the stock market again as well. So here's one of the problems. The Fed just printed too much money here, and after the first collapse of the banks, they printed an insane amount of money. It rescued the banks to some extent, but a lot of the liquidity went into the stock market. And then here's where things start to get complicated. All that liquidity stretched stocks. Tech in particular, this is the S&P, stretched it way too far above this 200-day moving average. And I warned people that there was going to be a regression event, that stocks would not be able to hold these lofty levels above this 200-day moving average. All markets eventually regress to the mean. And so the stocks started to correct. And the Fed has been trying to fight that, and especially, as I said, they're trying to keep the banking sector propped up. They don't want that breaking down, making lower lows. It didn't really stop the correction in stocks. It did manage to stretch this out another complete daily cycle. This intermediate cycle, it started here. This intermediate cycle should have bottomed with this daily cycle. We should have had some kind of crash event, a really scary bloodbath phase that would come down and probably test or maybe drop a little below the 200-day moving average, and that would be our bottom, and then we would be off on another intermediate degree rally. But they pumped in a lot of liquidity into the markets, and they managed to stretch this intermediate cycle out another complete daily cycle. That doesn't happen very often. It shows you, just how insane the liquidity pump was to try and keep those banking stocks propped up. So they stretched this out another 6-7 weeks, whatever this was, and then I'm confident we've got our intermediate bottom here. We're not gonna stretch this out another daily cycle. We've bottomed here, but all of the liquidity, they were pumping liquidity during this whole time. They're panicked about that banking sector, and that liquidity found somewhere to go, and I'll show you where it went. So when everything else topped at the end of July and started to unravel, and the Fed started to print, to pump liquidity into the markets, it just didn't stay where the Fed wanted it to. That's kind of the problem with having a printing press. You can print a lot of money, but you can't, there's no way to force the liquidity to stay in the sector you want it to stay. The same problem happened back in 2008 when the housing market was collapsing. The Fed printed an insane amount of, or pushed an insane amount of liquidity into the markets, trying to prop up the real estate market and the stock market, but the liquidity didn't stay. It didn't stick in those markets. It flowed into the commodity sector, and we had that huge spike where oil went to $147, created massive inflation, collapsed the economy, and then we had an extremely severe recession and the second worst bear market in history, all because the Fed printed too much money. So they did the same thing here. They printed and pumped an insane amount of liquidity, but it didn't want to go and stay in the stock market because the market was stretched too far above that long-term mean. It needed a regression event. And so it went into the energy markets, and it gave us this very powerful move in energy all the way to this resistance zone. And this is where I suggested people should take their profits, was when we tagged this resistance zone here, because now energy is stretched too far above the 200-day moving average, and it needs a correction. Now, I don't know whether we're going to get a bounce and then another leg down, and an A, B, C move that typically is what you see during an intermediate correction, or whether this is just kind of a really severe daily cycle low and we're going to come back up and break this and maybe come up here to this next resistance zone before we get an intermediate cycle low. And I don't know which it is, but anyway, you can see where the liquidity went. The Fed wanted it to go into the stock market and especially into the banking stocks, but it didn't. It didn't stay there. It may have gone there initially, but sellers just drained that liquidity right out of those markets and started pumping it into the energy market, because that's where the bull market was at during this period from the beginning of July onward. Now on to gold. All right, gold topped kind of the same time that the stock market did here at the end of July, and it's been in an intermediate decline as the dollar has rallied. And the dollar rally doesn't mean that the dollar's strong. It just means that the euro is weak. You can't have a strong dollar with the Fed pumping that kind of liquidity, and we saw exactly what happened. It shot up the price of oil. But I'm pretty confident. I am confident that stocks have completed their intermediate cycle low. Gold has almost certainly completed its intermediate cycle low. We had a very normal, typical bloodbath phase. Those don't just continue on forever. And about the time you start seeing people come up with ridiculous predictions of 1,600, 1,400, 1,200, that's the bottom. That's the point at which everybody is sold and everybody has become bearish, and then there's no more sellers left and you get a bottom. So if the dollar has topped, stocks are going back up, and I think bonds have also bottomed, and they're going back up for at least 8 to 10, 12 weeks anyway. And that's going to release pressure on stocks. It's going to release pressure on gold, especially if the dollar's topped, and I think it probably has. Energy is the one unknown that I'm not really sure whether liquidity is going to flow back into energy real quick, or whether it's going to have like a B wave bounce and then another leg down into a C wave decline. So I wouldn't be exceptionally heavy on energy again, expecting what just happened over the last several months to immediately repeat. That's one of the problems that people have with markets. They get a strong move that runs for 2 or 3 or 4 months, and then you get a correction, and they automatically assume that it's just what just occurred is going to resume, and usually it doesn't do that. The liquidity will find something else that's undervalued and move into that market for a while. So I'm suspicious that energy is probably going to be maybe a little difficult for a while, maybe several months, before it's ready to trend again. So I think the trending move is probably ready to start again in the stock market, and probably the metals market as well. So all the liquidity is still sloshing around. It's just looking for undervalued areas to flow into. Once a market gets too stretched above the long-term mean and is in need of a regression event, then that liquidity starts flowing out of those kind of markets like the S&P and tech, and even gold. Gold has been correcting since this. We were stretched a long ways above the 200-day moving average at this point. We needed a correction, but now liquidity is probably ready to come out of energy, and energy is probably going to be difficult for a while. And now it needs to flow into other markets, and I think it's going to flow back into the stock market. Maybe. Now, tech didn't really correct as much as I would like to see. So stocks may remain a bit difficult. They may not just take off and soar to the upside. Metals, however, are stretched too far below the 200-day moving average, so I think they could be a big beneficiary of this liquidity that is now probably ready to come out of the energy markets. Maybe not the energy stocks, though. Energy stocks may just follow the stock market. But that liquidity is going to want to find markets that are maybe ready to have a regression event in the other direction. And that would, the market that most qualifies for that would be the metals, because it is stretched too far below the 200-day moving average, whereas stocks just came down to tag it. There you have it. That's what's happened. The Fed has been pumping liquidity, keeping those banking stocks afloat. The liquidity has flowed mostly into energy. That's probably done for a while. Now it's time to slosh back over into some other assets that aren't necessarily in need of a regression event. Gold is the most obvious, or metals anyway, is the most obvious market, with stocks probably coming in second.